Well, howdy there, folks. Welcome to this 5-piece here today. 5 videos up here for me to react to. First one up here, we're going to react to a video back from 2022 of me putting $10,000 into a stock. So that should be an interesting one to watch there. Then I'm going to go ahead and get into this one. Meta joins the dividend paying crowd. Here's what it suggests. Then we'll react to this one here. Rosenblatt raised its price target on Meta. This should likely be a cycle now around Meta where people are going to raise price targets, bring up their estimates, things like that. So I want to get into that one. Then we're going to talk a little economics and what's going on with the U.S. economy here. U.S. economy in the jobs numbers that came out there. And then last thing up here is we'll react to factory orders and what's going on in regards to that. Okay. First off, all I need from you guys, smash a like and make sure to subscribe to the channel. We just hit a new all-time high subscribers, I believe 38,300 plus. Appreciate each and every one of you. And also, just so you know, I just bought 3 stocks in the Patreon portfolio. If you want to see what stocks those were, there'll be pinned comment down there. That's also an opportunity to support my content. And yeah, pin comment down there. So, and by the way, congrats to all Meta and Amazon shareholders. It's a very, very good day out there. Yeah, Meta's booming today. Booming. By the way, you don't want to know what else is booming? This. Trevor just sent these out. 8 new people just hit 5 figures in their stock portfolios for the first time. So congrats to those folks. Those are all members in the Patreon. So once again, if you want to join there, that is the pinned comment down there. Alrighty, guys, let's get into this.
If you haven't seen, Meta stock has absolutely collapsed here today. It has been an awful year to forget for Meta stock. I stepped in and bought about $10,000 worth of Meta stock here today, and I'm likely going to continue to buy that stock for the remainder of this year. What's going on with Meta? Well, over the short term, obviously, they pretty much run the world. They own Facebook, they own Instagram, and they also own WhatsApp. Instagram Reels has been taking off in a massive, massive way. So for the short term, obviously, it's the place to advertise, right? It's a tougher advertising climate right now because business opportunities are weaker. I think we all know that, right? But at the end of the day, once the economy gets back on the right tracks, guess who's going to benefit the most of anybody? Obviously, it's going to be Meta, right? Long-term, Metaverse is a massive opportunity. Wall Street doesn't understand it right now, and Meta is in the lead in that market. So I love it for the long term, and I will continue to buy for the next few months. Peace.
So, yeah, and I mean, you know, if you went to the comments of that video, it's definitely, you know, a lot of people were not on board that train. Let's just put it like that. A lot of people did not think that was going to happen in regards to that, right? But so what can we look back at in regards to Meta and say, now I could see it. Now I could see how that stock could go from $88 to, you know, today people are paying $450 plus for that stock, right? I think there's a couple key things. Okay, and if you want to look for companies in the future, you look for a few things here, okay? One is strong balance sheet. Meta had the strong balance sheet, okay? 2, they had proven they could be extremely profitable, but they had simply overhired. And so understanding that they could cut employees quite substantially and their profitability would go up immensely, very important thing to understand about a company like that, right? Next component is a business model actually in trouble? When I looked at Meta's business model, it was not in trouble at all. Facebook was fine, Instagram was fine, WhatsApp was fine. So their core businesses were all just fine. There was no problem there. The problem was around profitability. They had overhired. That's an easy problem to fix. To fire people. Like, it's not like this is rocket science, right? And then Zuckerberg found that the company is actually much more efficient, actually streamlined as a smaller organization and with not having as many employees as around. And so he found that the company could actually move faster. And then also you got to look at the valuation. Meta at that time was trading on the dirt in terms of valuation. Like, basically people were pricing that like it was the stock was done. When you looked at, you know, what the profitability the company brings in versus where the PE was at, never mind if they cut employees. I mean, it was like a night and day difference, right? So, you know, those were many of the key factors. So when I look out there, you know, there's one company I see that fits all those criteria, in my opinion. And I don't think this stock's going to go up as much as Meta went up, but I think it's going to have a pretty fun run over the next few years, and that's PayPal, right? And when I look at PayPal, valuation on the floor, good balance sheet, the products aren't in trouble. PayPal and Venmo are doing just fine. And so and they've overhired, and they're going to be able to let go of some people, and their profitability is going to go to the moon. And so that's another company I look at, and it reminds me of Meta 2.0. We'll see where it all plays out over the next few years, but it reminds me a lot of Meta. Okay, alrighty guys, let's get back into Meta. Meta joins a dividend-paying crowd. Here's what it suggests.
First ever dividend. Could this be a sign of mega caps maturing, and which others might be next? That's the focus of today's Tech Check with Deirdre Bosa. Happy Friday, Dee.
Hey, happy Friday, Carl. Well, you can look at Meta's dividend as part of a broader shift among tech over the last few years. It used to be that high-growth tech companies, they invested every dollar of profit back into the business to develop the next generation of innovation. But higher interest rates and the push for profitability, that has led to more discipline, better cash flow, larger reserves, i.e. more money available to return to investors. So it got us thinking, could Meta's surprise dividend pressure Google and Amazon to do the same? Here's the state of capital returns among the big six. Apple.
What were the two stocks I told you would be paying up dividends next? I said next up is Google and then Amazon. Oh, by the way, and if you're wondering Tesla in regards to a dividend, here's the deal. I don't think Tesla's paying a dividend anytime soon. And when I say anytime soon, I mean for like years. I think Tesla's got way too much going on. They got this obviously tough time period they're going through with the price cuts and everything like that. So they'll get out of that eventually here. But with how much Elon wants to spend on different projects, I just don't see Tesla paying a dividend anytime in the next, I would say, 3 years, maybe 5 years from now, 7 years, 10 years from now, but not right now.
They've had robust programs for years, but they've also been around the longest, and so they have more mature businesses. Meta is the youngest of the bunch here, and that is partly why its dividend was such a surprise. Now, Amazon has been around for nearly 30 years, yet it doesn't have any capital return program, but it didn't start posting consistent profits until 2015, when its high-margin AWS cloud computing unit started making up for narrow margins in e-commerce. Even then, it continued putting those profits back into the company, like doubling its logistics footprint over the pandemic. This quarter, though, everything seemed to start working for Amazon. Operating income soared, way better e-commerce margins, and interest income. That was kind of the cherry on top, an added benefit of higher yields on its growing cash pile, and that is a benefit among all the mega caps that have reserves in the tens or hundreds of billions of dollars. Now, Alphabet is interesting. It does have a buyback program, but it has resisted issuing a dividend for years. And this is classic Silicon Valley. Put the profits back into moonshot ventures like self-driving cars or internet balloons. But what has been amazing, guys, about this year of efficiency among the mega caps is that they have shown investors that they can do both. They can innovate in areas like generative AI and spatial computing, and they can also return capital. They just needed a little more discipline and focus. And it feels like Google has got that message, and they've been taking a harder look at its other bets, Moonshot unit and its workforce, all while growing its cash reserves and improving margins. So investors, they might start wondering if a dividend is next. And maybe the biggest reason now is that Meta's doing it.
And I mean, here's the deal, okay? These companies make so much freaking money, okay? So much freaking money that they can build their cash while simultaneously paying a dividend, while simultaneously doing a share buyback, while simultaneously investing in the business and building out for future revenue opportunities ahead. They make so much money, it's ridiculous, okay? So you can do it all. You can do it all. Believe me, these companies make plenty of money. Next one up here, let's hear why this gentleman raised his price target on Meta, and what did he raise it to?
With Rosenblatt analyst Barton Crockett joins us now. Barton, first let's just start with Meta. I mean, the revenue acceleration at scale 25%. Is what a lot of longs were talking to me about this morning. Do you share their amazement?
Very much so. Look, I think that we've all been looking with really kind of amazement at what NVIDIA's been doing, selling, artificial intelligence chips. Meta's been buying a ton of those, and what they put up in this report suggests that they're putting that equipment to very productive use. Their revenue growth, I think it was up 22% in the quarter. The guidance would suggest it can accelerate in the March quarter, even though the compares are tougher. And this is really these guys going full bore on artificial intelligence. They're integrating that into everything they do, and it seems to be paying off for them. So it's really kind of the first proof point that this whole revolution that we've been talking about can work.
Yeah, I mean, AI, as you point out, seems to be positively impacting the return on investment for advertisers. Will that just continue to accelerate as well?
As best we can tell. I mean, look, this is...
By the way, there's one thing that could get in the way of Meta stock here, okay? And it could hit the stock later this year. We'll see. But the one thing that could get in the way is the government. If they changed, in terms of... I've heard rumors that they might try to change... something in regards to consent policy, in regards to Meta, and make it just not as good, which could hurt Meta's revenues at least a bit. So, and have some sort of adverse effect on the business. So that is something there. It doesn't sound to me like that's nearly as big of a deal, though, as the Apple situation a few years ago when Apple changed their privacy policy in regards to that.
Big new world. I mean, this is, an environment that we haven't seen before. And these guys are leaning into it and they're making it work. It's interesting that it's Meta and it's not Google, right? I mean, Google is all about the technology, but Meta's, really kind of using it better. And part of that is their business model. So, it seems that this can continue. And it seems like this is a rocket that's worth riding. So we stick with our buy rating. We raised our price target. We think you can own Meta here.
No offense to Google, right? But what did I tell you guys, years ago in regards to Meta is I want to ride with Zuckerberg, right? He's the only one of now it's the Mag 6. So if you look at the Mag 6, who's the only company other than Nvidia that's got the big dog, the original dog, still running the company? And it's Zuckerberg, and he seems extremely hungry. Obviously, look at the two best performing stocks, right? Jensen at Nvidia, and Zuckerberg at Meta, right? And they're running laps around everybody else. Satya Nadella's done a heck of a job at Microsoft, but has he done as impressive of a job as Jensen's done with NVIDIA or Zuckerberg's done with Meta over the past year or two? No. And he's done a good job. Tim Cook, he's done just fine as a CEO of Apple, but has he done as good as Jensen over the past number of years or Zuckerberg? No. You could say it's the same thing with Sundar Pichai over there at Google McDougal, right? And so... when you go through these companies, it's clear, like, having the founder be the CEO of the company is huge, right? And you think back to Apple in the Steve Jobs days. I mean, that was a different growth animal back then, my gosh, right? Even if you think about Microsoft back in the Bill Gates days, that was a different growth animal back then, right? And then Steve Ballmer took over and it wasn't quite as exciting anymore.
Some people talking to me about a $27 a share number for 2025. Do you think that's a possibility? And then let's just get to multiple. What is a deserved multiple here for a company whose stock has always sort of traded perhaps at a lower multiple than might have been expected given its growth rate?
Yeah, look, I mean, I'd have to look at my Excel file to give you my number for a couple of years from now. But, we do think that the EPS growth is going to be impressive and supportive of the stock. And there is a re-rating argument. And these guys are returning capital to shareholders. I mean, they're a good share repurchaser, and now they're a dividend payer. So we think it all stitches together. Okay,
so here's the stock rating that they have on Meta stock here. All right, so they have a $520 price target. They had it at $411 before. We'll see how long that holds until they move it to $575, and that's $625. But anyways, Amazon, they have a $220 there. Apple, they have a $189. I think those are all fair. I think they're probably just a little low on Meta there.
Where we'd argue that you can get, the stock up to $520 in the next year, and we think that that's a great place to be sitting right now.
Yeah, I think they might be a little low. That's my personal opinion there. We'll see. All right, let's talk a little economics now. U.S. economy at 353,000 jobs in January?
Got the number in just 2 seconds. Rick?
That's a couple of seconds. The first jobs report, jobs of 24 is out, and it is whopper 353,000. 353,000. We have to go in the Wayback Machine. That is the biggest non-farm payroll gains since January of 23, when it was 472,000. And if we look at the unemployment rate, It is 3.7. It's remained at 3.7. And just for history's sake, the 3.4 low that we had was the lowest since 1953. That was in April of last year. If we look at the average hourly earnings, a huge jump, up 0.6%, up 0.6%. It equals March of 22. To find a higher number, you have to go to January of 22. And also, for some context there, the amount of year over year is also popping 4.5%. We were expecting 4.1. The year over year average hourly earnings began as a data set in 2007, pre-COVID, all the way to when it started. The high was 3.6. It's 4.5. 4.5 is the highest level going back to February of 23. If we look at the average work week, 34.1, that is a drop. It's been at 34.3 or 34.4 going all the way back pretty much to beginning of last year. So that dropped 34.1. I don't even know if I have a record going back. That equals March of 2020. And 62.5 is the labor force participation rate. And if you recall, 62.5 was last month as well. It is going in the wrong direction. Finally, the underemployment, or U6, moved from 7.1 to 7.2. 7.2 is the highest level in that series since Dece of 21. Interest rates are popping, equities are dropping, and this is a report filled with strength surprises. And if you're thinking that average hourly earnings year over year or month over month is going to be something that Chairman Powell and the Federal Reserve Board studies, you're darn tootin', that's correct. Andrew, back to you.
Yeah, so in my opinion, going to be in for a little bit here. We're going to be in the fun part of the economy. What's the fun part of the economy? Low unemployment and real wages that are, in a very good place. And that's kind of what I foresee for 2024 for the most part is, low unemployment, 4% or under, and a situation where real wages are looking great. Now, at some point that will change. It might be a year from now, a few years from now, right? And we'll have the next recession. We'll have an unemployment cycle, those sorts of things. But for right now, this is kind of a fun part here for a bit. And it's good news overall because certainly we've had a low unemployment rate for a while now. But the problem was 22 and 23, and even part of 21, people's real wages were not in a good place. Real wages were actually going down for several years in a row and continue to be in a bad spot up until very recently. And when I say very recently, I'm talking really over the last 3 to 6 months. Folks have finally started to feel a breath of fresh air in the middle class and feeling like, ooh, man, maybe things are looking a little better because now you don't go to the grocery store and everything's massively more expensive. We go back a year or two years ago. It was like every single time you went anywhere, it was like, oh my gosh, this price just went up again and again and again. That's not going on anymore at this point in time, right? And so that's a positive benefit overall there. So that's why I say this is a fun part of the economy here for a little bit. All right, next one up here, December factory orders rise 0.2% in line with expectations.
Up in the street, Rick Santelli here, live at CMEHQ with the last breaking news of this wild week. University of Michigan sentiment. These are January finals. We will replace mid-month reads. 78.8 now becomes 79.9. Still the best since July of 21. And
79.9 Michigan Consumer Confidence Index. So let me be very clear. That's definitely improving massively. We hit the lowest in the history of that survey, which goes back all the way back to the 1950s. We hit the lowest in history in 2022. So, which tells you how bad things have really gotten, right? Really great to see confidence improving among the consumer. That's still not even a great number, though. Keep that in mind. We have a long way to run. Like, we could have easily a year plus of getting that confidence back in a better and better place. That confidence is not high right now. It's okay. That's the best way I could describe it is we've gotten back to an okay place, but we've got a lot of improving to do when it comes to consumer confidence.
Current conditions.
And if the longer the consumer's in a place where real wages are outstripping, let's just call we're gonna be in a much healthier environment. People are gonna feel more confident. People don't feel confident when either they can't get a job. Well, one of two things kills a consumer. They feel like they can't get a job. They hear everybody's losing their job. That hurts, right? That's when you're going through a big unemployment cycle like we went through in the great financial crisis, or what we went through obviously in Rona there in the short term, right? Or a second thing that kills consumer confidence is inflation. When, it feels like I can't get ahead because although I'm working, it's just like everything's so dang expensive and the prices just keep going up. Finally, we're at a place where the prices aren't just keep going up. So, that's good news. Obviously, there's always going to be a little bit of inflation, but people can deal with 2 to 3% inflation. It's when it's like 8, 9%. No, that's going to destroy consumer confidence when you're dealing with that.
From its mid-read from 83.3 down. This is unusual. That's a pretty big move. 81.9 down to 81.9. That would end up being the weakest since the end of last year when it was 73.3. Why, you ask? Because 83.3 was such a big jump. Also, before the change of that mid-month read, that was the best since July of 21. Expectations moved from 76.0 to 77.1. 77.1 is the best going back to July of 21. Now, let's go to the important things. 1 year inflation, the mid-month read 2.9, it remains at 2.9. And finally, 5 to 10 year inflation, last look on mid-month read, well, it was 2.6. Now it moves to, it was 2.8. It moves to 2.9. So 2.8 to 2.9. 2.9 is the highest level of inflation there since the end of last year, November of 23, when it was 3.2. Now, factory orders, these are fresh numbers. These are December numbers. We're expecting up 0.2. It arrives at up 0.2. You strip out transportation, it doubles to up 0.4. So we could see that aircraft orders most likely were a bit of a drag on this number. And if we look at durable goods, now these once again are final reads, which means the mid-month read gets tossed out. Mid-month read was unchanged. It remains at unchanged. Ex-transportation, initial read 0.6. It moves down to 0.5. And finally, capital good orders, non-defense ex-aircraft, a proxy for capital business spending. Well, last look, mid-month, it was up 0.3. It is now up 0.2. So we lose a bit there. Interest rates, well, interest rates have had a lot of movement before the number. A 10-year note yield, for example, was down 12 on the week. Down 26 on the week. Now it's only down half of that. Sarah, back to you.
Good info there, Rick Santelli. We all appreciate that, okay? Hope you guys enjoyed today's video. As always, thanks so much for being here. Also, if you're looking to support my content, do so on Patreon. That's pinned comment down there. You also get to see the stocks I'm buying and selling each week, which I just bought 3 stocks in there today. Yes, today. All right, guys, much love and have a great day.